Thank you everybody for joining we normally do a series of webinars around data analytics, and I think just a little bit about our company in one slide, but I do want to get into the meat of it around credit cards and credit card analytics and really all the things that are going on in the industry. I'll link to that. I'm a part of EXL. EXL actually acquired our organization. I used to be a part of a company called IQR Consulting. And if you're in the credit union business for a few years, you may have heard of us working very actively in all kinds of analytic type projects, ranging from member attrition to engagement, product-specific models such as cards. Just EXL at a glance, like I said, they acquired us, and as a result of that, we're now part of a much larger organization. But of that, obviously, is that we focused on a few technologies, more cutting edge in what we're bringing, and hopefully that will reflect in the presentation too, if necessary today, but over time you'll start seeing that there's a lot of work going on in the industry as you think about analytics, even beyond this presentation, really to automation, robotics, more we're hearing about artificial intelligence, which we've been hearing about for many, many years, but it's come to fruition a different sort of way, more in financial services also. Quite a bit going on, and if anything to take away, as a credit union, if you try to get involved in analytics, realize that that rate of pace that you are trying to develop in-house or build out or buy is faster. It's just a little bit hard to keep up, and as you can see, we're looking that into many verticals across the board. A little about the presentation. I'm speaking too fast. Please jump in. And I'm happy to slow down or repeat anything in the course of it. Reasons you should enhance your portfolio. I mean, if you're credit cards, a couple of cycles. There was very few credit unions that even did it. If you go back 20, 25 years, then it was introduced. It was really introduced as a bit of a side product, never really focused on. People realized credit cards could be profitable. I used to work for Capital One at the time, and if you follow the banking space a little deeply, Capital One is the sixth largest bank in the country. A few years ago, all they did was credit cards. So it really is a very engaging product. It's a very, very active product, and it really is one that you can build on substantially. Question there? Could you also just, since I have the screen up, if there's any comments that come back, just feel free to point them out and take over from there.
Yeah, and I was going to make this at least a 40-minute interrupted presentation, and then you can do a Q&A following. That'll be easier. Okay.
Yeah, I way it works. Whatever's convenient. If somebody has a question, stop me. I'm happy. Sometimes you have the slide up, and it's relevant at the time.
Okay.
Whatever works.
Yeah.
It's an informal presentation. Yeah. So I think Act came in around 2008, and Card Act was building for a while, 2008, and then the second version 2010. That has the momentum we saw that the credit unions were taking on, that pretty much put that to a standstill. The market went into a recession 2008. And a lot of portfolios were sold. A lot of portfolios were credit unions went under. There's been a lot that's happened, and the result of that is that since 2010 and 11. They've been relatively gun shy in terms of what they do when it comes to cards. I mean, it's an unsecured product, right? It's the first one that you're going to default on, if you're going to default at all. So keep it in mind. But what we are finding is that landscape is getting very, very competitive. So I'm going to a little bit about the competitive landscape, very basic credit union versus benchmark bank comparisons. Hopefully some of this is not new to you. I know we have a split group on the phone. So, it really should paint a picture of what are some of the differences we see there. So card cycle, different type of campaigns, and then I want to walk through a case study associated with limit increase. And limit increase because we do a series of portfolio reviews, and when I come into credit union, very often it's like, hey, why is my product not really competitive? Why is it not performing at par? Upgrades and some of the things I talk about in this presentation, credit limit increases tends to be, credit limit reviews really be one of the things that are more than times a top need for that portfolio. Conclusion. why should you enhance your card portfolio? I already touched upon this. A population carry card and credit card is 3 to 1. So when you look at a third of the population, there's young, very, very young folks, there's old folks, there's the unbanked segment. Start looking into the bankable segment. A third is substantial. It's close to like 65 to 70% of the folks carry cards today, and then average 3.5. So there's a huge amount of cards that are in circulation in the market. It's like no other product. Your auto loan, you get an auto loan, and then you're locked in for, I guess, auto loans is close to about 3 years. So let's say for the next 3 years, you're not really looking at a loan again. These mortgages, these are longer-term products. But it's something that you might pull out, some people might pull out every single day. That's the right brand, having a credit union brand on it, speaking to the success of that product. I mean, all of these things are very, very important in developing the member relation. Averages are low. I mean, you really have to get them young. This is a bit of a contradiction because I know Card Act says 21. We still see that the average age limit for first-time cardholders is 20. Moved substantially. It used to be lower, so it really is moving towards 21. But it is a card that, if you can get into members' hands relatively early in the 21, 22, it will help you have more cards out there, but it might help you appeal to different demographics than what you might have today. 34%. 2008, 9, 10, we saw a tightening of budget. I mean, it used to be really high, 44% into what balances people were carrying. And what it means is that there's 100 cards out there, 44 were really carrying revolving balances, that is paying interest. We've number dropped down to 34%. So there's been a hard shift in terms of risk. So a lot of credit unions don't do cards or are slow or not aggressive about cards. It's a big concern about, I mentioned, the unsecured risk that comes with it. But only 34% are carrying it. And next, delinquencies are not as high. If you look at the delinquency trend, the delinquency trend has been going down consistently over the last. Now we've seen a slight spike in Q1 and late Q4. I shouldn't spike, a slight rise in Q1 and Q4 of last year, but for the most part, the delinquency trend has been going down for the last few years. So people tighten their budget, managing their spend better, are using the card more wisely. So I would call everybody to sort of rethink inhibitions you may have with your card program. So what does the landscape look like? I mean, you've got credit unions member-owned, their interest rate on deposit products. Yeah, that's the other thing. It's very, very deposit. I mean, it's all about member give back. So find the rates on cards are low. The rating products is low. Of course, the rates on the deposits tend to be a little bit higher. Now, what we found on the banking side is that they're very, very, the rates tend to be higher. So you can get a rewards card from one of the 5 banks, and the interest rate, don't be surprised if it's 25+%. And now the rates are rising a little bit, might be 20+%. On the flip side, they also are very, very heavy into the incentive side of things. So they're very heavy in incenting their cardholders. Question a lot, should we have, a 7.9% card be really competitive, fixed variable rate out there, and have rewards on it? And I want to compete with the American Expresses or the Citibanks or the Chases. And the reality is that what they're able to do that is they're also charging very, very high interest rates. So you have to pick your battles and figure out how you're going to, if you compete on rate, very hard to compete on rewards and incentives. So things to think about as you look at your cardholder program. Could be slower to buy but quicker to act. And this is kind of interesting what I say, because we work with both, we work with both credit and banks. It's a long time to get somebody to be convinced. I think that's just a little bit of the risk nature of credit unions. But once on board, we do see that activity happens pretty quick. It's rolling things out. So their time to market can be fast, especially when it comes to cards. It's not a product that takes a lot of tweaking. Now, if you're rolling out a new product like a Visa Signature or a compelling Citi Plus or Rewards Plus type products, then that does take build up in time. But to do little quick changes up pretty quickly than that. Where next really you're going to come through the red tape more often than not. But the other thing that we've seen, and like I mentioned, we do work with both sides of it, that we have a lot of success in the campaigns and the activity and the strategies that we roll out for credit unions or banks. And the biggest reason why is there's loyalty factor, and I know that's something that we all tout as credit union members. Loyalty to the credit union cannot be underestimated. It's such a shift. I mean, in the same kind of campaign, if I'm getting 2, 3, 4x the results within a bank. So that loyalty, again, it does vary from bank to bank. Some banks have a pretty deep loyalty segment too. I used to across the industry, credit unions are far more engaging when it comes to their membership and that reflects on the responses we get. So I will walk through a credit limit increase example. That same situation pops up there. We see that credit limit increase has a much greater impact on the credit union side than I see on the banking side. Also, the smaller, flexible, local focus that tends to be there. We see a lot more when I think of campaigns and rewards. I hear of credit unions talking about give backs to the community, or even the incentives rather than doing broad-based strategies. They're like, well, let me see if I can. If I'm a patient-based credit union, well, why don't I actually strategy that's now going to the output or the benefit of that go to members to the education institution. So it's very focused into sort of what the membership is built around. A Chase is looking at a national strategy, and you miss that. Bank far behind. I think Bank of America might have 1,000 plus. With a credit union of the size of 400, 500 million, very, very hard to compete. So that's still driving the change that's coming in the industry. Tech, if you notice, as you see more and more fintech, banks are stepping up a lot quicker than unions are, and smaller credit unions are into space. So they're leading the way, but credit unions are really seeing a lot of benefit from that because of that loyalty factor. Budgets. I tell a credit union, let's go out and target 20,000 members, and I can feel the tension that rises when I say that. The bank can say, let's target 200,000 members. It was sweat. So just a bigger marketing budgets means that credit unions have to be a lot more selective, and in fact, even plays more important role in how you leverage analytics in-house. It's almost become more credit unions to be doing it. Cards. Some of this, lower interest rates, low fees, very balanced transfer fees. Then sometimes the credit union will tell me that we have really, really good product and we want our members to be drawn to it. The reality, though, is that membership, the broader consumer base, isn't used to the idea of rewards. Don't use the idea of getting something back. There are some members who are drawn to a low interest rate, and you see if you do a rate-based strategy, you will see some lift. But the members are out there seeing that if I go to Chase, I could get 1,000 points on day one or by month 3. It does affect decision making. So while you have really, really good products, rates, the sort of what you're giving back to the members is viewed differently. That the member give back on the shareholding side for credit union is somewhat replicated on the product side for the bank. So a bit of a competitive nature there also. Very attractive rewards. Bank charge numerous fees under scrutiny we already know is happening. With the various amendments that are coming in, etc. Limits. That's one differentiator we see. Limits. I mean, banks are far higher when it comes to the credit limits. I remember the stat, and this is a little bit dated now, but its credit limit was about 400, whereas the average bank was 6,700 in a particular state. So that's just a huge difference there in terms of the credit limits that are being offered. And it was a regional study. So, these things, again, reflect in terms of the members' engagement. If I give somebody, if I have 2 cards in the mail on the same day, one has a credit limit of 3,000 and one has a credit limit of 5,000, it sends me a very different message. Just realize that when you are offering really conservative lending practices, whatever reason that might be that you're doing it, just keep in mind that it does send a different message to what they're receiving outside their membership or in the market. Mentioned my background. I started my career at Capital One, and since then I've done some consulting. A lot of it has been in the credit card space. Now, of course, it's a lot broader. and you speak to automation, robotics, and other lending products, and a lot of good products. But is really my current infancy, and it's been something that's been very, very passionate to me. And I speak to this again and again. It's like patterns of members change. I mean, and the very classic example is if I get somebody as a cardholder in the days when the moment they graduate, because they have little to no income, the graduate, you could be making $40,000, $50,000, $6,000 income. So I've got a very different type of a consumer. And if you don't have an upgrade strategy in place, then I'm probably missing out on a little more of a interactive relationship with this particular member. And the other thing is that behaviors can be grouped. I used to use my cards I thought was so unique. I would have one card that I used only for travel, one card for gas, and then one card for pretty much everything else that I was doing. I have a unique pattern that I could segregate my expenses. I was also benefiting a little bit on the rewards because of the cards that I picked to do that. The one for gas gave a much higher reward for I found out, very, very early on that I was not the only one. And I'm sure a lot of you on the phone also have different cards for different purposes. But the here is that we all have behaviors, and the behaviors can be grouped. As much as I think I'm unique, I'm not really unique when you start looking at the size of a population. Understanding that will have a profound effect in the way you look at your membership, also look at your card holders. There's a very simple analysis that's done. This is a little bit, again, very, very basic. It's called the trip analysis. If you see that, say trip. Trip is on the cardholder side is actors, and these are the folks that track and pay that balance every month. The revolvers, those are folks that use the card as a loan, so you get some interest income, but also spending tool, interchange. Then you have inactive cardholders. Those of us don't use the cards. They got it a while back. They're disengaged. You just have that plastic sitting out there. Pay downs. Pay down is somebody who's maybe taken advantage of an offer or a promotion that you had at a point, and then use that, but is gradually paying that down. So you're not seeing a benefit over that, in terms of engagement. It's some home equity line or home loan or something. You've got a balance, you pay down every month, and when you're done with it, you're done. Very, very simple citation really of your cardholders, and you can really get a lot deeper into that. You get transactors and say, well, who's a high dollar transactor, low dollar transactor, high volume, low volume. So the information, and today we have this information, and it's so easily accessible. With it, the strategies that come up with, that's where the real challenges are. So if you're still struggling with understanding your cardholders, you're maybe a little bit behind the game there. I would encourage you to sort of start looking into that a little bit more. You can start understanding and coming up with strategies specific to those segments. Know who your inactive cardholders. That's a very common one. Most of you all should be looking at your inactives. Figure out what is it going to take to get my inactive cardholders active. Rather than doing card-based, I'm going to give everybody a 2x or some amount of cash back over the holidays. Well, be active, figure out try to target your inactive members with a little bit more of a compelling offer so that they change their behavior and start spending and come back to your card. Versus you're just going to do something that's sort of a blanket approach or a shotgun approach, right? So to think about how you engage your members, how you segment them, and how you engage with them. And all institutions struggle, and even the big banks or the small credit unions, is in that. But what happened? I did something, and I've been doing a 1.9 auto loan campaign for the last years. I get good results. This year, results went down a little bit. And most of the credit unions, what happened? You things like, well, there's a bit of a market tightening. There's a real estate push. We're competing with other products. Well, the reality is that that information will tell you all more than just sort of making market speculation. So understanding what is coming out of that makes for the real value in any kind of strategy. It talks about data analytics, and beyond even cards, we'll say test and learn, actively use, sort of, kind of move the cycle where you are looking at the information, learning from it, and reacting to it, and sort of building that into more of a cycle. So I thought cards are exciting to me, and maybe sense the passion a little bit coming through the phone, but it's there. So the life cycle of a credit card. The acquisition is relatively scientific, and we sometimes will oversimplify things, sometimes we'll overcomplicate things. But the reality is that there's more than one way to look at card cycle. I mean, there's acquisitions. You may say that my acquisitions and activations are all built into one thing, but you get a card. Who do you decide who gets the card holder? And getting a piece of that. How you roll it out in your branches, whether you have pamphlets, whether you have your front end staff talking to it, speaking to acquisition offer. And I'm sorry to say, if you don't have an acquisition offer, you're already at a disadvantage because there's related offers, there's point-related offers, there's term-related offers. And I mean term, I'm saying get a card and we'll give you a balance transfer for the next 6 months. That's month term, right? So it's there's a lot of different things out there that appeal to new prospective cardholders. This goes a little bit beyond, because sometimes you're looking at new cardholders amongst your membership. You already have a relationship. But more and more I'm finding credit unions are looking at my card appeal outside of my membership, and can I use cards as a lead product to build membership loyalty? So let me get somebody in the door with a card rather than direct auto, which doesn't have a depth relationship to it. Let me get somebody as a card holder and offer other products that will really deepen and solidify that relationship. How quickly they activate speaks so much to how they're going to use the card. We know, the 2 weeks, 4 weeks, 6 week, 3 month mark. Those things mean different things when it comes to activating the card and using it for the first time. We know if somebody just all they do is a transfer and don't activate the card, by the time 6 weeks rolls around, that person's probably just taken the card for a benefit, something of the sort. So acting quickly key here. There's usage, there's account management. I don't want to spend a whole lot of time on each one of these, because as Srikanth said, the presentation will be available to you. But note that each one does play in the cycle. I mean, building loyalty, for example, I so much now about the fact that rewards is a strategy by itself. Everybody has it, so how can you differentiate your product on the website and have it? It's something worth looking into. But as everybody has it here, do more with that in terms of engaging your cardholders by using that particular tool. If they're earning enough, the reason people don't redeem rewards, apart that may not be spending a lot, is because they don't necessarily know about the reward. I'm sure you have a lot of reward holders then the points and are not using, especially now more and more with moving away from paper statements. The paper statements, it was pretty, you open it on the first page, you'd see the rewards, and so you'd have that standing of how much I've accrued, how much I had, what I can redeem. Sometimes even you'd have a page or two in there that gave some offers as to what they could redeem their points for. With the shift to statements, more people are not necessarily even opening them or looking at them. You look into your sort of your card info or your platform to show the card, your online banking situation. You can see the balance, you can see them on payment, and you can see when it's due. And typically, what cardholders are looking at now, very few will actually open that statement and see what rewards. So as a result, that some of the bigger institutions are now starting to place in that immediate login, rather than having to log into the portal, log into the card screen, you're able to see that reward. So they're trying to find ways to get that. People are not using it. You really need to educate your cardholders on, because we've seen that people who redeem their points are engaged and are typically even more profitable than folks who don't, even though they're redeeming their points. Retention, I think, given at this point, if you're losing cardholders fast, there could be many reasons. A very competitive environment, your product's not compelling, your limit's not right, your rate's too high, the face of the card isn't. I mean, there's many reasons why people would leave. People moving, closing the relationship with the credit union as a result of that, they're leaving the card too. But things that can be looked at, those are things that can be evaluated, measured, and acted upon. And that's the big thing about data analysis. It's a cycle. The first thing is really understanding it, so the intelligence piece. The real value to it is actually taking that intelligence, diving a little bit more, and then acting on those specific pieces. And that's where moving as an industry. So I was here for a second to see if we have any questions yet, or are you still until the end?
Karan, I think, just to complete the presentation because I'll be receiving, message in chat.
Okay.
And definitely, we can go to your slides, right, when people have Q&A, yeah.
Absolutely. I just wanted to make sure if there's something that I talked about.
Yeah.
So card, there's a few things you can do. Yeah, sure. You think about, this is now I'm looking at an active engagement. So now you have the cardholder on the acquisition side in the bottom left. Line management, this balance transfers, and this spend. This is normally what folks do if y'all are doing that too. There are other things like repricing. There's other things like upgrades, and also have a strong effect. But typically the phase of the card, the stage phase of the card. And when you get in cards, how do you increase your penetration? How do you grow the business? What achieving with that? Line management is about really mitigating risk. This is an interesting point because I get a lot of credit unions that say, I don't know if I want to do a credit limit increase because I don't know if I want to take on more risk. I paused and said, I don't think that's what you mean, that you actually want to take on more exposure, not necessarily taking on more risk. The simplest example of that is that if I give the best cardholders line increases, then that not necessarily increase your delinquencies, it actually reduces your delinquencies. However, yes, you do take on more exposure. So it's a matter of getting them comfortable with exactly what the implication of what you're trying to do is. Retaining members, handedly, credit line increases are the most impactful when it comes to a member-facing strategy. Foundation offers, obviously, balance transfers for help build up balances in the quickest manner you can. Campaigns is interesting because we work with folks who do a lot of spend campaigns, and I'm told oftentimes that spent and we saw a big jump in spend, or we didn't see a big jump in spend. Well, say we saw a big jump in spend, but the balances really didn't stay on. I think to understand that a campaign is about bringing that spend to your card. It's not necessarily about increasing balances from staying on that cardholder. Spend campaigns are used more to build loyalty, and that take time. So you'll see an initial jump, say, in your spend as a spend campaign. That will taper off because that's an initial jump. And over now you're doing, if you do that a few times, you will be becoming more moving up in that cardholder's wallet. That's the important thing to realize about spend. I talk about a couple of strategies a little bit more, and then I'll jump into a few slides around the credit limit increase case study that we did for a credit union. For an increase limit adjustment, there's really 6 stages that we've identified now. I'm a data analyst, and I love the idea of looking into things more from a standpoint. So I probably have close to 12 or 15 stages that I look at when I look at an increase. But to bring it down to the basics, understand the situation, understand the history, understand what data you have. Have bureau data? Do you have things in-house? Do you have that information? And then that exploratory analysis. So figure out what are the trends. Is my card portfolio on my existing cards? I take out my new cards. Is that going down? Normally, it's a sign of intense competition. By default, it's going down at a good click. Understand that. What are the relationships? And dive into that information. And then the exclusion process. So now you've decided, I need to do a line increase because my lines are not very competitive in the market, hypothetically. And so jumping to that delinquency piece, we talk about, what are the delinquent cards? What is the basic logic that I want to exclude? And creating a FICO band. I think typically most credit unions will just look at FICO as the sole determinant. We don't recommend that. We think we've seen with credit unions, taking a FICO as an exclusion is a very basic step there. I think it's one of the factors that should be considered because of that T component that I talked about earlier. So it was a 660 credit FICO, have a very different loyalty picture with a credit union as they would with a similar banking institution. So realize that loyalty does play into it, and put a lot of value into those internal metrics. So as, how many times has they've been delinquent on or other products at this institution? And they're using it. Have they been consistently? They may have gone delinquent and over limit on another card, but have they started reaching their limits on these cards? So are they probably becoming riskier? If not, then it comes back to that I value this relationship and I don't want to necessarily So realize delinquents are it's broader than just FICOs. It's broader than just looking at the one time I've gone bad to the relationship and what it means to me. Create expectations, understand those personalities, decide what members read what limits. So you're not just, let's just take everybody who's below 5,000 and give them $500. Everybody's below 10,000, give them $1,000. That is, a lot of credit unions do that, and it seems like the simplest way to do it, and even be the simplest way to do it. However, it's not the most impactful, and it doesn't necessarily always send the best possible message. To me, example, so do you have the expertise to kind of go back and look at it and speak sort of what you were expecting? Did you perform as you would, etc. This is a little bit busier, so I'm going to speak to just the key points on this. The balance transfer campaign, which is done as something that, it's what's in the market. Sometimes we just look at that and say, let's just replicate it, or it's what we've done for the last 4 years, so let's replicate that. A few have changed in the market. There's marketing channels. Now, should you use email? No, a lot of credit users are leaning towards email. Also know that the responses you get from emails are still nowhere near at par when it comes to some of the other channels. So understand what your marketing channel mix is. Do you want to really highlight the transfer on your website? Do you want to put it into the card login system? Do you want to send email? Do you want to mail it? Outbound telemarketing. There's a lot of different channels you can use. First, there where we saw banks were doing, and they still are, they pay 0% for 12 months or a 2% for 18 months. I have multiple offers in there. There's a price, a promo duration. I offer different prices, different offers segments. So do a balance transfer and we'll give you 1,000 points, or do a balance transfer and get a certain rate for it. Now varying it up beyond just the price of it. And then the other thing what we're finding is that this doesn't happen a whole lot, but I think there's a lot of value into this. And we good responses where it does happen. In sync for higher dollars, but capping it. Sticky balances that we typically see, it used to be 2,000 to 3,000. Now we're seeing it's really between 25 to 4. People who transfer typically between 25 to 4,000 have the balances that sticky on the list. So how can you get people to do that? Find ways to incent them, and that's why I'll give you, a point or dollar. They might, for every dollar you transfer, cap it at 4,000. So that there's other things you can do that help come down and sort of narrow into how you want transfers to be done. So a little bit more control than just having a strategy out there and expecting members to respond. The response window, we don't recommend keeping these things open. We recommend 6 to 8 weeks. Vendors going out after that, or during that sort of second half of that campaign. Segmentations, I think it's really important that you exclude the risky cards. An example of this again is, or the response groups. When a risk group is somebody, for example, you will look at your score and you know that they don't have any unsecured debt out there. You can send them balance transfer offers till your base, but they're not going to respond because they don't really have a balance to transfer over. So you might have a substantial group of members like this, or members don't have another card, so you're already using your card in a very, very engaging manner. It doesn't really serve any purpose by having them do balance transfer offers. And there's about 8 or 9 different ways that we can actually build a response model. Someone who's responded to a balance transfer offer previously, it's been a certain amount of time, primary person to get a balance transfer offer because they see value in the products that you're bringing to them, especially if kept the balances on. So you have people build up balances. It's really for them to shift those balances from other cards to you. Just to give you some sense of what kind of results you can get if you apply the right techniques. It could go to 1.6% all the way to 9.5%. The revolving balance, if really factor in things like the response or some kind of scenario building around here. Spending on similar thing. I'm going to move a little bit quickly because I do want to get to the case study and leave time for questions. Understand, create your segments, assess them, apply them, analyze them. And this is really about the chain of the cycle. Don't go with a blanket 2X. I gave the example of if somebody's inactive, maybe give them a 5X campaign just to get them back in the door, to get them to find that card, if it's their wallet, and bring it out. Or to use the card once and hope that it moves to the second spot or the first spot in the wallet. Very rarely will you go from a drawer the first spot, or very rarely will you go from the third spot to the third spot. But at least you're moving in their wallet, which is all you really want to do initially. And that's a big win in for an active campaign. So you spend campaigns wisely. They are a necessity. I'm sure you do them, but by some segmentations and some logics, you are able to influence them in the way you want. Blanket things, you're probably incenting cardholders who are already using cards, or somebody may have another card and using this card and you're giving them 2x. You're almost incenting them for what they're already doing. So keep in mind too, you really can reallocate your marketing or your incentive spend in that membership engaged. Skip a payment, 2x. Nothing of this is earth-shattering. There's very few true changes that have come around in the way of offers. We are finding, just in our research and our projects, we're finding more and more relates to mobile offers and things that are new. Use your Samsung phone or your iPay, Apple Pay extra times, and we'll incent you. We're finding more and more offers tied to Uber or Amazon spend. So people are looking at different ways to engage because they know that once you start doing that, it starts to build loyalty. Really, the spend campaign is all about loyalty. Some strategy here. I mean, really, this is about, I touched on some of this. Reduce risk, pre-identify the prospects, looking at your target population, and your budgets are. By looking, you may have a target population of 1,000 members that you want to go out to. Well, this is not, but if you factor in what do my current cardholders look like, who is the card user, you may be able to take that 50 and bring that down right up to 20,000. So saving almost $1,000 in mailing. So there are ways by applying data analysis that you can actually bring that down to far more targeted and still get close to what you've got it, otherwise in terms of responses. There also be the theory that if I go and say something to 100% of the people, that I will get all the people that were going to respond. It's evolved a little bit too, say that, really each person doesn't want to hear the same thing. So when 100% people are saying the same thing, you're better going to 50 people and 3 different things that really appeal to them. Again, marketing and, figuring out that 50 or those 3 that's where value is coming in. This is about how you can use credit limit increases as a way to enhance your portfolio, a way to sort of build on it and make it something that's the value of the card. You should be doing it. Increase is one of the leading ways that you can actually have quick results in your card program. So if you're struggling, you haven't seen a lot of growth, that's one that just to start invigorating. Now, it's not the only thing you do. And really, card management is about an ongoing, an active lifestyle thing. I mean, you got to move with the card, you got to be active and be in your members, as in the way that you're engaging with them on an ongoing basis. It's not a credit limit increase and I'm done approach. So keep in mind, so it helps in driving portfolio performance, engagement, and if you're done right, it can lower the risk of the portfolio. Holders want it because it's more flexibility to buy, and it really does send a positive signal. I think that's a big thing to know. And now people are financially savvy enough where that if I have a higher open to buy and I've reduced my bureau utilization, that has a positive effect on my bureau score. So there's many ways that sort of the card holder really do see that value. But again, actively, when I was Cap 1, I think we should do credit limit increases every quarter to a point where they want to do it every month, if I remember correctly. But again, it was a much larger cardholder base, and so that warranted them at the time. But I would recommend credit unions really should do this twice a year. If you don't wherewithal the bandwidth to do it twice a year, but do not miss out on this opportunity. The other mistake that you might make is if, say, I gave somebody a limit increase last year, I don't need one. Realize it's going back to what I started off saying is people evolve, people's lifestyles evolve. Where I think you should do it, but I'm saying that everybody should be considered every single time, that you're not necessarily missing their opportunity, because they're, again, probably receiving a card offer from Chase that's going to say, make it twice as good of an offer as what you currently have with them. I think I have a couple of slides left. This particular credit union,
Karan?
Yes.
This 2 is when I see 14 to the top of the hour. And I was thinking, should we start with the Q&A? And depending on how it goes, of course, we'll be posting the extra case study, and then we'll see, and then we can continue. Is that okay?
Just we have 3. Why don't I take 3 minutes and wrap it up, and we'll keep 10 for Q&A. Because I think that case study is just of value if you actually do explain it. $100 million credit union, 36,000 cardholder, 30,000 members, series of exclusions, and basically came up with just 2,700 cardholders, give an increase to. Seen in line with what Srikanth said, and moving quickly. The segments here were, we looked at utilization and bureaus, we looked at what their FICOs were, the credit limits, and eventually came up with just a little table here to demonstrate back to the difference. So the difference between these two groups here is, if you look at, you can see my mouse says 660 to 719 FICO group, and out of $2,500 or less than $2,500, had average profit of $2.19 per month. That the only difference between that group and this group down here, that group and this down here was that this group had a bigger, higher credit limit, and it was close to $10. So all else being equal, the only differentiator was the credit limit, and we saw one had $2.19 per month, whereas one had $10.55. So this made the point that moving that line, if you could just get that group on the top, replicate the behavior on the bottom, we would have seen enough of an increase in profit for holders. With credit limit, this is in October of 2012, so I wanted to have enough data, at least to present it here, and we saw an immediate spike. So if you see the test and control, that's something that most analysts will use, which control is hold back and not do anything to these cardholders purely to see the difference in performance. Difference in the number of purchases, the payment balances started rising substantially, and the profit. We saw profit. I mean, this was 2,700 cardholders. Of the thing, we eventually only did it to 23 because we held back on the group. 1,000 in profits. Cardholder balances were up, and so on and so forth. So we saw quite a bit of increase. So that particular credit union said, "Hey, that was great. You did it the first time. I'd like you to go back and again look at that control group that you excluded, as with any other cardholders, to another line increase." So for a $400 million institution too, this had a substantial impact into numbers. The impact was something that we that daily expect was we attrition dropped in the group that got the credit limit increase. The non-group got 2.5%. The increased group got 4.5% or 4.3%. A big in delinquencies. This is what I was talking about earlier, with the delinquencies not necessarily going up. So 4% delinquencies in the credit limit group, and then the one was 7.5%. A really good job of excluding that had any risk. That rate really correlates to the dollars, so your losses. 0.3% for the credit limit increase group, and then 0.83 for the non-credit limit increase group. And then something I think you can look at other time is other things that you can do to your portfolio to make sure that you're relevant to your cardholders, pricing, underwriting, rewards. And keep your cards active. I'm a strong proponent and supporter of cards. Analysis, really smarter about the way you're using data. It's not that complicated, but it does require a start. Analytics, to your fuel growth, member retention, there's a lot of things you can do with that. So with that, I will questions. Time now, I think the last 10 minutes. So about that, Srikanth.
Hey, no, perfect. The slides are very exciting. Obviously, the case study is very important. So, Karan, once again, we'll learn. Our credit program is one of the best ways credit union can create value for members. Thanks. So to build loyalty, etc. I was taking notes, and also I have a couple of chat sessions open where people have asked questions. But I'm going to wait for an opportunity for somebody who want to ask a question right away before I take those chat questions. So the phone lines are open. All of you should be unmuted. Do send me a message if you are not.
So I think while we wait for questions on the phone,
Right.
I actually like this format, especially that how you looked at it from the engagement point of view. I see that this PowerPoint, the whole flow that you showed, can very well be used by various credit unions, various people on the phone, drive engagement with the respective consumer line leaders within the respective organizations to talk about how we should approach the solving part of the various initiatives from the business perspective. Right? One of the questions that I have, as the way this is Naveen, is around the value, especially where you were showing that the credit line increase leads to X times increase in the net income or profit. I would love to understand, is it in a way also tied to the risk, associated risk with it, or do you think that the credit line was increased with keeping the risk factor as constant?
So that's a good question. I think to understand that, so the ROI varies from institution to institution for a few reasons. One is, of course, their current underwriting and risk policies they have in place. To give you a simple example, we had a $500 credit limit at one of the institutions, and we proposed them to move to $1,500. All dollars on both sides, right? But we proposed a $2,000 increase, and they had a policy that we cannot do more than 3x. And so we eventually had to bring that down because I guess it was the first round of increases. In year two, we moved that person up again. The results you see are strongly driven by the constraints that are put in place. But in terms of profitability, its credit limit increases is one of the most effective way to engage your card program and returns quickly. Risk itself, I haven't seen risk go up in some of the credit limit increases as a portfolio. Now, risk may go up a little bit, but again, your balances are outpacing that, right? So the delinquency rate really, or charge-off rates haven't gone up. But as part of the process, it really isn't engaged. It's not like EXL or IQR goes off and comes back and tells you the answer. It's here's what we think the answer is. Does this match your policies? Very often it has to go through our ALCO committees and get approvals. So we do make projections on what your risk is going to be. We have to align that to where the credit union wants to be. I think another question there too, Naveen, by the way. There was somebody else who was asking a question.
Hey,
Yeah.
I'm an analyst in our card product team. Thank you so much for the presentation. It was very insightful. But question about balance not credit increase, something we're definitely interested in and want to do. So about Card Act, how do we overcome the ability to pay regulation? How has other union go around that?
Ability to repay is one of the last steps that we do as a part of that recommendation. Where income is available, with income, is to drive that, as well as the total unsecured debt that particular members. And so you get a lot of that information from the Bureau. More institutions are capturing the income as a part of either a recent loan application or are proactively able to capture that into the systems by asking the members, when I log on to my Capital One card, almost every time it asks me for my income. I don't give it, which is probably why they keep asking. But so there's ways that you're starting to capture income. Also do leverage the income models that are available at the Bureau. And based on that, unsecured debt and a model in place, an accepted model in place around what taxes, utilities, etc., is able to do that. Eventually, so I gave that example of 2,700 holders that we gave the line increase to. We find about 0.5% or so will not be able to receive the limit increase we're proposing because of ability to repay. We handle that normally is either exclude those card holders or reduce the limit that we will propose them. I'm happy to talk more about that, and I don't want to take up all the time, but you can drop me an email, and I can talk to you through that a little bit more.
Okay, we'll go to the question. Anybody here in this room before I the credit limit topic has been pretty exciting. It seems the higher credit as we can grow and increase the average profit per account. That's what the chat window is reading. He's talking about, this gentleman is asking a question. He says credit unions have difficulty getting upper management to buy into credit card program. So what would you recommend? Reduce the risk by identifying profitable and risky prospects. What's your experience? How we can go about it?
So, that's not a credit limit increase challenge. There's a challenge for, I would say, pretty much any proposal that you take for management, because of everybody's strapped for resources, everybody's strapped for being risk conservative, and so there's many issues that come with that. But specifically, if you ask about credit limit increases, I think that we know that there's certain benchmarks in place in the market, and I think that tends to be, you want to have a competitive card product. Let me just pause you for a second. Did you say this is for the buy-in on having a card product, or specific to the line increase?
It was part of the, as you had mentioned somewhere, the penetration rate of a credit card by union as you open an account at some low percentage, right? So he was asking, what are some of those? That was the question, and then obviously he went into saying, when you talk about just increasing the credit limit, what's the, how do you really go about identifying profitable and risky prospects?
Yeah, so that's a bit of a loaded question. I'd probably recommend that coming off. But let me answer that in a bit of a way. There's one, we don't have a portfolio. And it sounds like the person asking might have a small portfolio, just a starting portfolio. If you don't have a portfolio, that takes a series of different conversations with management around why, again, demonstrating the results. If it's an early stage portfolio and you're growing, then typically what we find is folks have conservative underwriting rules and very active acquisition rules, just because they're trying to really grow the program. All efforts go into that. So when you go to management and say, how do a line increase, the typical answer is, let's just focus on getting more cardholders. That tends to be some of what we run into also. So what we do in cases, we have a lot of, because we work with quite a few credit unions, so we can show where how actively managed new programs perform as opposed to actively managed new programs. The line management thing, I think that tends to be, it loves benchmarks. I mean, we seem to love benchmarks. So we start with the benchmarks and say, this is what we're seeing in the market, this is where you are, and this is why you are lagging program. And that seems to work well. Apart from that, of course, there's success stories. And when I try to go out and get any new credit union, we try to get them to talk to institutions that were hesitant before, took a chance. And the way I do to answer that question is, work small steps on convincing management. I used to go out and talk about all the things that analytics could do, all the things that card analytics could do, and realize that I need to bring it back to just one or two things, and that is easier for them to swallow and move ahead with than, and eventually we get to all the things anyway. But it's just getting them started on the journey of realizing that they make my decisions better. Did I answer that question? Sorry.
So for me, definitely, yeah. And as you said, you're right. That's kind of a very heavy, loaded question. Yeah, a lot of things there. Upper man buying into that. So we are at top of the hour. Thanks a lot, everyone. And Karan, thank you very much for this wonderful, session. And we will be posting. I'll be posting the recording in two places: LinkedIn group and culytics.com. And people have asked me in the chat, will I get a copy? And that's the answer. We will post it there. And do look at your box for future presentation. We'll be doing that every month. Yeah. So
if you have specific questions, you can drop me a note, and I'm very responsive and receptive and happy to answer. Mission to sort of help unions grow, and so we're aligned.
That's everybody. We'll end the session now.
Thank you.
Bye.